Good evening, everyone. Uh, really apologize that we have already, I know we began session itself 1 hour late. So I'll try to cover whatever I can in the next probably 2 hours. So uh, we all know that revenue recognition is one of the important topics in any kind of environment, even from a business perspective as well as auditors from a financial statement perspective, even as accountants. No, revenue is key, right? Um, so we all know that India is introduced somewhere back 6 years earlier, right? 2017, 18, we had the first transition. But over the last 6 years, we still see a lot of application issues around India is 115. Still, we have certain fundamentals. We frequently try to revisit the fundamentals on India is 115. So, I've been an auditor throughout my life. I mean, 15 years I've been auditing, and still I can tell you that one of the place where still I go back and check standard 10 times. This is one of the standard that I do check. Even after continuous years of understanding of the standard, still there are a lot of complexities that come to us from time to time. So, uh, covering the entire standard in 2 hours is impossible. I'll only pick and choose some 4 to 5 topics which in my view, will have a lot of practical application, considering whatever experience that I have, and uh, I little bit understand the dynamics of our state, particularly Vijayawada. I know more focused on trading, a bit of manufacturing, and probably I'll touch real estate here and there. I think service sector. I think I'll try to focus on these 2 3 segments. Keeping these 2 3 segments in mind, I will take you through the session. So before we start the session, there are like 4 to 5, I would say, definitions which we all have to understand from a Ind AS perspective. And we all know, right? Ind AS is only applicable for companies which are listed companies and where net worth is exceeding 250 crores. In case if these two criteria are not satisfied, we will go with AS9, which is accounting standard 9, which is very, very different from, I would not say very, very different. Fundamentals, some still argue that it is same, but the kind of guidance we have in 115 isn't there in AS9. So it's more practical. The standard setters have taken a lot of effort to understand the pain of the industry also. I mean, the standard is, pretty thorough and elaborative, I can tell you. So IFRS is usually, or India is usually is principle based. So once we understand the principles, it's lot of interpretation that we have on hands. US GAAP is more rule based. So that's why there is a lot of scope of judgment in India's 115. So let's just start with 4 5 fundamental topics. First, I'll talk about. I'll not. Don't worry about the order of the slides. I think I'll just first take you through few fundamentals. Okay, in terms of 4 to 5 topics. One is customer. First, who is customer? Okay, we all know customer is the person to whom we sell services or to whom we sell goods, right? I mean, it's as simple as that. But we just have to understand the granularity of the standard on what customer is from a standard perspective. Okay, customer from a standard perspective is only a customer who, in the ordinary course of business, if a company transacts and if you are buying in that context, then only it is a customer for all practical purposes. Example, you are a manufacturing company. Okay. Uh, as a manufacturing company, you sell products, whatever the product is, right? But if you end up selling a plant and machinery, that's not in the ordinary course. Your objective is you have set up business to do 2 3 products. You have done it. But incidentally, you sold some other goods. That will not come under Ind AS 115. So, if in the ordinary course of business, you are in the business of selling plant and machinery itself. Say we talk about very large companies who also deal with capital goods. So for them it is in the ordinary course. But if for a manufacturing company, if they are selling plant and machinery, it's not in the ordinary course. So that is one point we should keep in mind. Just more relevant example, same manufacturing company usually generates scrap also, right? Whenever usually there will be process scrap. The question is, Whether process cap generation is in the ordinary course of business. Okay. One answer could be no, because I don't sell scrap in the ordinary course. The other way to look at it, if there are proper byproducts which usually come in the course of manufacturing, for which there is a explorable market. For example, sugar industry. We all know about molasses, right? So that one can construe that still it's in the ordinary course of business. But in the same relative example, if I say some unexpected scrap got generated, which is not in the ordinary course, some breakdown, something happened because of which you had to lose a lot of material. That, in my personal opinion, might not construe in the ordinary course of business, because it's something you don't expect repetitive. Now, why even we should discuss this? Okay, just imagine, we are all again. I think I keep going back to basics. Today, we all know how NFRA is, right? It's been very pushy. Today, we are, irrespective of whether we are, big fours or the ordinary firms, everyone is getting notices left, right, center from NFRA. And who knows, NFRA might even extend its jurisdiction even on the small companies. We never know it. Okay. So, now why I am bringing NFRA into my, I mean, now we are all becoming more and more skeptical. But clients, they usually don't change. Okay. They want maximum amount of revenue to be recorded. They always want to show higher revenues. I mean, it's natural. Everyone wants to report higher profits. It's a natural tendency of any company. In our profession, we are in the risk management profession, obviously. So, one important aspect we always have to keep at the back of our mind is, if I'm calling something as revenue from contract with customers, scrap in our context or plant and machinery sale in the earlier example can never be part of revenue from contract with customers, because it's not in the ordinary course of business. So if we get the customer definition right, first we will know how to look the scope of the standard. I mean, there are other aspects which we should discuss in terms of what India's 115 will cover and what it will not cover. But to start with, I felt customer is something which we all should know. The other tricky part is identifying who is customer in slightly different context. Okay, I just put one example here. So again, you can forget what is there in the screen. I can still explain you. Do not worry about understanding the huge volume of text. So again, you can relate in your field, right? Whatever I'm saying, you can see you have relative examples. So if there is a media agency, okay, a lot of media agencies buy space. It could be electronic space, because if you are trying to, these days advertisement happens a lot in social media, right? LinkedIn, Facebook, Google, right? And parallelly, we have space on the roads where media agencies buy space. So the question is, lot of times you do customized ads as ad agency to a third party who actually want to get ad agency services from you. The other side of the coin is, these companies also, as it is, sell the space from publisher's viewpoint. Sometimes it's tricky to identify who is your actual customer. You have at one side advertisers asking you for services for the same space, and then you also resell the advertisement space without any much value addition. Both can happen in this media agency industry. So what I'm trying to say is that we have to know the context in which this particular transaction happens. So in the example that I'm trying to say is, using the space, you are actually trying to create an impact for for your customer in the form of customization of ads, etc. Then obviously your customer there is the person who is taking the ad revenue from you, the ad agency. For example, it could be a product a company like Lux or whatever, any FMCG company is coming to you. So that will be your customer. But if your ad is selling the space, your customer is actually your publisher. It could be a LinkedIn or a Facebook or someone who actually is selling you the space. So please understand that the context in which the customer itself we need to look sometimes changes, right? Now the second fundamental concept is distinct good and service. Okay. Again, don't worry about. I'll give you the context also. These 4 5 topics let's discuss, and then let's dive into the standard. Okay. Why? What is this distinct good and service? Okay. Now your customer business model can be anything, in the sense he sometimes offer a host of products, not a single product. The challenge for all of us is, today, for example, if you talk about we all buy two-wheelers, right? We all buy two-wheelers. So now I'm just trying to turn from a OEM perspective, like someone like a TVS or a Eicher, okay? When they sell the product to us, we look at the features. We say, okay, I've got the bike now. They are saying 1 year they'll give free of service, and then they will probably have a roadside assistance package, something like that, right? So we have a host of offerings, okay? Host of offerings along with the main product. Our main product is still bike, okay? But why we get usually we choose, right? We choose the products. How do we choose the products based on the features. We choose the products, right? So the interesting part from a 115 standpoint is each of these feature can become a service by itself, because of which you have to split the revenue from a company perspective. Our customer mindset is I look at the features and then I choose the product. The same thing applies to company also. If suppose you today go and buy a bike for 1.5 lakh rupee, no, he is not charging 1.5 lakh rupee exclusively for the bike. He's telling you 2 year free of service, but he has to incur cost no for 2 year service. So it's part and parcel of his 1.5 lakh billing. Similarly, roadside assistance, all these he will subcontract to some third party, and the third party would perform. It's like insurance policy, you can say. 10 if you for all the for all the bikes, not every bike comes on the road and goes for repair. Maybe some 10 bikes will come, so they accordingly the price and all will be quoted by company, by the service provider to OEM, and he will accordingly split the cost and include it in your pricing. So he's pushing all this in the product price. So the product price is actually not exactly the bike price. It has a lot of other components. So the what a standard setter has done is he observed this for a long time and he said, boss, you're selling the product and you're taking everything in revenue on day one. Okay, you're making provision for warranty and all, but you're not even entitled to compensation. You are entitled to compensation when actually the service is delivered, not till that point in time. So, if suppose 2 years is your warranty benefit you're offering to customer, for that portion or fraction of revenue, you need to wait for 2 years time. So, but I need to first identify, right? How many of these touch points are there in an agreement? That is identifying distinct good and service in a contract. That is where this context is coming from. So every time when you do go for an audit or you're an accountant, you try to get understanding on the agreement that your company signed with the customer. One, we need to first look at what are the products and services involved in this first, and how distinct they are from each other. Believe me, this looks very plain and simple. It is the most complex topic in 115. It's actually not complex, but unfortunately, because of the business models that we have, it's pretty difficult to understand the nuance of what is a distinct good and service. I'll start with the basic example. We all go and purchase fruits and vegetables, no? Dozen apples if you purchase. 12 apples, each apple is a distinct good and service. Okay? Because what the standard says is what is distinct good and service? Distinct good and service is nothing but any product, if you can use the product on its own or with the help of available resource. Apple you can consume on its own. You need not, I mean, of course, you can say, I want to have apple juice. If you have mixie, then it's also in a way, you buy a mixie, it's not a big deal, right? So, if any good can be consumed on its own, then it has distinct good and service. Then you can ask me, every product will have this. No, what is the challenge? No, every product will not have. For instance, we have this laptop. In this laptop, there is an operating system. If someone says, I'll give you operating system, okay? If you have a laptop, yes, with operating system, you can make it readily available for use. But if I tell you that this operating system is so specific that it only works on a specific hardware, and I only have that hardware. If he is selling you the operating system, what is of use to you? You have to buy the hardware, no? So what I'm trying to say, then it is not a distinct good and service. Hardware and software is not. Product is hardware plus software. Like that, you'll have a lot of instances in your clients where you cannot say, for example, in construction industry, beautifully what they have done is if the person gets an idea, I want to accelerate revenue recognition. So what he does is he breaks down the costing. He says bricks for constructing house, say 50 lakh is the hypothetical number. Then he says bricks cost 10 lakhs, cement cost 20 lakhs, steel cost 10 lakhs. He puts a bill of materials. Okay. Then he says, I want to recognize 90% revenue. Okay. So what do I do? I basically enter into an agreement such that I split the bill like this. So I am customer. Okay. I came to a contractor. Contractor. Now we are talking about accounting in the books of contractor. Okay. Contractor said to customer, 50 lakh rupees I'm going to charge for construction of the house. Said, okay, I'm fine. Customer doesn't anyhow bother about accounting. It's not his forte. Now for this 50 lakh rupees, intelligently he prepared one bill. All materials 45 lakhs, construction service 5 lakhs, total 50. So what he did, he purchased all the materials and he put it in the godown of the customer. And he said, I'll recognize 45 lakhs revenue. Now the question is it right? Why? Any thoughts? I mean, I'm logical, I know it's not sounding right, but now technical, we are talking technical. At the end of the day, the guy is going to come and tell you all the goods are already bought. You see the bill, these many items are ticked off. Literally there in front of you. Why are you saying that I can't recognize 45 lakh revenue? What will be your answer if your client says this? Not completed. What? Yeah. So, put to use what? So, for example, if you are same apple example, I will take. I have supplied apples. No, you would not do anything with the apple. How is that is my problem? Just agreement completion of house. Okay, that I think somewhere we are getting. Construction agreement is for completion of the house. So what if I say that yes, construction agreement is for completion of the house, but this is the cost breakup. If I put that also in the agreement, then what will be your argument? I agree. I think you have a fair point. Construction agreement has the wordings. I think now we are getting somewhere. Yeah, I agree. How do I argue the client? That is again the distinct good and services will come into picture. All the nine materials we have, except that service portion. What customer will do with all the materials? Your promise to customer there is construction of a building. It's not supply of materials. Even if that breakup is there in the agreement, the guidance of 115 is very clear. The distinct good and service there is the house itself. It cannot be bricks, it cannot be cement, it cannot be steel. That's very important for us. We need to know what is a distinct good and service. Because if this concept we are not getting it right, we don't know how to look at the contract itself. Now we know who is the customer, how we need to look at the customer. Now in the contract, we want to know first what is distinct good and service. I'll give you another interesting example. We know this cleaning service, right? A lot of companies take cleaning service these days. That also they are giving it to professional organization. They come, they clean, they go and all that. So there, if you look at it, they also perform a lot of activities. For example, if for cleaning, they have to get a lot of materials and then they have to do service and they have to go, right? So how do we deal with that? What is distant good and service there? I mean, any thoughts? Any one of you? There again, the contract will be for doing XYZ service. So how do we see that in the context of let's just apply, no? We will learn something, let's apply that. Again, there also there are series of activities. Let's not forget that. So to complete a service, he has to do a lot of things inside the building. Probably he has to scrub all the chairs, he has to clean all the floor. No, basically we are the auditors of some of these type of companies also. So they then we are also their service recipients. So they come and do a lot of things. Okay, when we come early now morning, we know all this. We come around 10:30, 11, everyone already it's all neat and tidy. But if you anyway happen to come early, then you know that they are doing a lot of activities to come to that clean stage. They put even a lot of things to ensure cockroaches and all don't come. A lot of things. There are like ton of activities. But how do I identify performance distinct good and service there? So there what standard said is they got another concept called series of distinct good and service, series of activities relating to distinct good and service. So there also we are saying service only is the main thing. But you do a lot of things in a service. So what they said is these all activities have got a common feature. That is to provide, say, cleaning services to clients. Like how we are looking at construction service, it's cleaning service to client. So there, the distant good and service is still one. So next time when we discuss one more concept, you will know how this particular series of distinct goods and services, especially like construction and service, where you should do lot of activities to complete a project. How they are different from a simple supply, or we will know why these two are different and how both cases will differently affect the revenue recognition. That we will see in the later phase. But I thought I'll just throw out the fundamentals. So we discussed contract, we discussed distinct good and service. Two more definitions we'll discuss. We'll discuss what is the performance obligation. Okay, very important. This is the series of distinct goods and we spoke about. So basically, the series of activities will still be same. They'll just repeat. Now you have done next month also you'll be do the same. You'll be doing the same thing. I mean, this is an example, but I think probably just let's step back. Okay. So for us to recognize revenue, fundamental thing is we have to identify. Once we identify how many distinct goods and services are there, uh, we will automatically end up identifying what are the promises made by the company to customer. And once these promises are fulfilled, we'll recognize revenue. This process is nothing but satisfaction of performance obligations. So performance obligation in one way can be equated to a distinct good and service. Almost you can say that. But why we are using the term performance obligation is sometimes what happens is when you look at distinct good and service, sometimes you might have to club to distinct good and service and say this is one performance obligation. There will be situations like that. We'll discuss those situations. But essentially, the concept of performance obligation is they are nothing but the number of promises which a company is making to a customer. Again, we'll take simple example: plant and machinery supply. AC. Let's take even more simple. AC. Okay. Say you bought AC in Amazon. Okay. Now, when you buy an AC in Amazon, your actual supplier will be someone else, no? Some other company. Say Samsung. Okay. From Samsung, technically you are purchasing AC, but routed through Amazon website. Now, when you purchase AC from Samsung, you get the product. What else you get along with the product? Okay, warranty. But for you to use, what else you require? You have to use AC. What else you require? Installation. Correct. So, okay, I think we all agree mostly that product is required, installation is required to that extent. Now, the question is, I mean, now let's understand why performance obligation is important. Okay, very important, guys. This is the most important thing in the entire standard. So, if we are talking about uh, identifying performance obligations, we are identifying the touch points of revenue recognition. The key question here is supply of AC and installation of AC. Are these two different promises or these two same promises? Any thoughts?
Different promises, one agreement.
Different promises, one agreement. Any other answers? So why do you think they are different promises?
Without installation, AC is also received.
Excellent. Independently, I can get installation done. That's your point, right? Any arguments on why it should be one performance obligation? Any one of you? Try know what is wrong. AC will work only after installation. So then without installation, AC cannot be used. So one performance obligation. That's your logic.
Without installation is also not performance.
Without AC, yeah,
Installation is also not performance.
agreed. Agreed. So again, this is logical, right? Now we need to go technical. The idea is logic. We should be able to look at technical. That is the whole idea of our discussion at the end of it. So now going back to performance obligations, our debate is if I purchase an AC today, the promise from the other side is I will supply you AC, I will do installation. The question is whether both of them are different performance obligations or same performance obligation. First, the reason we need to understand this is how should I recognize revenue? Should I wait till the time installation is complete for recognizing revenue, or can I recognize revenue when I supply the machine first, and then when installation happens, that portion I'll recognize separately. That is why we are discussing this first. If I am a AC company, if I am Samsung, okay, Samsung might send their own authorized people for getting the installation done. Now the question here is, as a company, if I bill 1,50,000 to customer today for an AC, and there is a 5,000, 10,000 rupees installation. You see how CFO will get irritated because we have these discussions sometimes on different matters, but I can just relating the conversation. For 5,000, 10,000 rupees, do you want me not to recognize 1.5 lakh revenue? Is the logic that CFO will apply. Okay, because installation will take probably 10 days time. It will cross my month. I'm closing my quarter for the current financial year. This much revenue I should recognize. What nonsense. Okay, first going back to basics. In our example, there are two separate performance obligations. Now, the reason we are coming to that, there is another concept which, when we discuss, we will understand to decide what is the level of integration between two performance obligations. When I promise a particular service, is one dependent on the other, and is one independently can we still use both? So, coming back to our definition of distinct good and service, okay? If I have to apply the test with this, okay, for installation, can I can installation benefit can be taken separately or not from anyone? Can be taken. Okay. Um, can customer benefit the installation service on its own or with a resource that is readily available? Is the second condition satisfied? Because I have AC with me, I can go to any third party vendor and I can get the installation. So both the conditions are satisfied. So that's why it's a separate performance obligation. Simple. So there are two touch points for revenue recognition. So whenever you supply machine, you recognize revenue. Whenever installation happens, recognize the balance. So that is performance obligation concept. Okay. So then the last concept, control. Again, very fundamental concept, very important concept, guys. Okay. We all know AS9, right? AS9 standard. When should we recognize revenue as per AS9? What is the main uh, criteria for recognizing revenue under AS9? Risk and rewards. Excellent. Yeah. You can say this control is that important, like how we used to see risks and rewards in AS9, relatively. Okay. So in AS9, we will recognize revenue when risks and rewards are transferred to the customer. But under Ind AS 115 or IFRS 15, we will recognize revenue only when control is transferred to customer. First, relative concept I am telling. Now, what is control? What is transfer of control? By definition, again, it looks very easy. Uh, as you can see here, it basically says that uh, if I transfer goods to any customer, they should be able to direct the use of the asset and obtain benefits using the asset. That is what it says. Not very complex. Basically, if you have a control of the asset, you can do anything, whatever you want. That is what they are trying to say here. Problem will come because lot of times goods doesn't they are not exchanged across the counter. For example, it's not that I'm here, customer is here, you are giving good, like it's not doesn't work like that. No, lot of times there are a lot of intermediaries between. Sometimes it could be transportation, it could be technology. There are a lot of other factors. It's not very simple that it just like that takes control. I'll just give you a practical issue that right now we are all facing. And I'm sure if you are any of you are doing trading concerns, or are you anyone doing trading company audits here? Just for understanding. No, no trading. Any kind of trading. Goods. Wholesale, no wholesalers. None of your clients are wholesalers. Surprising. Okay, fine. So what usually happens in trading is a lot of distribution model also this issue will happen if you are having a distribution model. So you when you are entering into the contract, so you are a distributor say, or you are the you know that there is a customer,
You also know there is a supplier. Typically, a trader will identify his market and he will connect the supplier, and he will not disclose customer name to supplier because that is bread and butter, right? So, and vice versa. A lot of times, what happens is he will not even take the goods in his warehouse. He will identify the customer and say, directly from there, you ship to that place. No, supplier doesn't bother. He needs his money, he will get his money. Customer will not bother. For him, I am the touch point. So, from customer perspective, I am selling. Similarly, from a supplier perspective, I am buying. But goods are directly going to customer. So, now look at that context and try to see, apply the concept of control. Now, the question that a lot of people ask, auditors ask companies, how are you actually controlling? Because you are never getting the good with you. Only momentarily at the time of supplier place, on that day you will probably put a bill in your tally saying that goods are sold. Goods are bought. On the same day you put goods are sold. So it's a momentary second probably. Okay. Then how you will demonstrate control? Do you have what kind of ability you have to control that particular product? That is the question which people are asking to for them to even recognize revenue. There is no control only for you. So there still the argument is you are an agent. You should only recognize commission income. That's the argument. Principal agent we will discuss. That's the most interesting topic entirely here, but I'll just park that. We are now sticking more to control. Okay. So I'll tell you my practical experience on how usually companies will define this. Okay. So in a typical industry where this kind of direct shipment to customer happens, usually the company which is buying the material and selling to customer, that company will have one person there at the supplier place. He will do all the inspection and all that stuff. Okay. Lot of these cases, what happens is once the goods are sold by the supplier, he will immediately take money. He will not wait. Customer will pay you 2 months, 3 months later. Immediately he will not pay you. In between, for example, there's a transport risk that happens. The first question that will come is who is going to bear the transport loss? If as a company, if I say that I am bearing the transport loss, which means you have control of that particular good because you are taking risk, no? The other perspective is if I can stop that lorry and tell to customer, for example, contract is to sell to customer A. I purchase from X. Contract is to sell to customer A. If in between it takes 2 days for the lorry to go to customer A, for the same product, I got another customer B, and it's very profitable for me. If I have power to stop that lorry and direct it to customer B, I'm controlling the good. If such kind of instances are there, then I am controlling the good. That is just to prove that I am controlling the good. This example is what I am giving you is only to prove. We are not discussing when to recognize revenue. We are just talking about the company's ability to control. Similarly, from customer standpoint, now I am going to from customer standpoint because this sentence is drafted from a customer standpoint. I am the trader. Vehicle started from supplier X, that point. Okay. The moment it left the warehouse of the supplier X, company A says that is my good. From that stage till the time it reaches to my warehouse, customer A. So he will record purchase because for him it is procurement, right? At the warehouse of customer X. Then me, I'm not having any control because I can't do anything in the transaction. I don't have any power to redirect the lorry to anywhere. Even the transport risk also will be of customer zone because he is buying from which point? From warehouse of X. So you are just a mediator. So who has the control? That fellow has the control. So X will recognize revenue, I will recognize revenue. Whether I am principal or agent, we'll keep it that aside. But I'm saying the concept of control is do you have ability to do whatever you want with the good? At that point in time, you have control. Not before that, after that, anyhow, you have control. So we are discussing which point in time you have control. Okay? That's why we said ability, learn to use, take the benefits. These are the only three concepts which are relevant. Okay? So these are fundamental concepts first. So now 4 concepts we understood. Standard as a whole is only 5 steps. Not very standard is very simple from a structure perspective. It says first to identify who is the customer, okay, and identify the contract that you have with the customer first. That is step one. Then you identify the performance obligations, which we discussed, right? What are the promises, right? Then you determine the price for each performance obligation. That's called transaction price. So in simple example, if we discuss that bike example, right? In bike example, we said there are a lot of promises, warranty, roadside assistance. So you have to see what amount should be transferred to each of this piece. That is determining the transaction price. Then allocating, so determining transaction price, actually the one that I spoke to you about is allocation. Before that, determining transaction prices, sometimes what happens is a lot of discount schemes and all will run. Okay. Earlier, if you look in our IGAPs, which is AF9 type of companies, trade discount I know we reduce from revenue, but usually discounts and all we show it in expenses. We don't reduce from revenue. But under Ind AS, that's not allowed. So Ind AS, what it says is, in simple terms, I'll tell you what is transaction price adjustment. If you go to any kind of Reliance Trends or these kind of shops, they give you discount voucher after discount voucher. Okay, we know how many discount vouchers we would have kept and tear them apart, and I don't know how many of you are buying, but at least I am most likely they're going dustbin only for me. So whenever you go to a shopping mall, they flood you with discount vouchers. And then on top of it, even when you're buying, they'll say 30% discount, 40% discount, all that stuff, right? Just imagine the retailer. At what price he should record revenue? Should he record revenue before discount or after discount? See, discount anyway is going to pay the price. I'm not saying no. But the question is, should I suppose you are buying a shoe for 2000 rupees? That is MRP. And he says 50% discount for the shoe. The question here is, you are anyhow paying 1000. I'm not doubting that. Should he show 2000 rupees as revenue and 1000 as cost? Or should he show 1000 rupees as revenue? That is the transaction price determination. What is the base value which needs to go in your top line? That is determining the transaction price. This actually is quite complex. It will only turn complex if your client is mostly in retail sector. There you will have challenge. Because in retail sector, you will have all these kind of nuances, you know. Again, sometimes penalties will be there. For example, if you are in the construction industry, okay, if you don't construct on time, you will have penalties. Easily we will say penalty is expenditure. Standard will not agree to that. Penalty, they what they tell you is you should frequently assess whether you are falling in penalty bucket or not every year. If you are falling in penalty bucket, you should reduce it from revenue. The moment you know that it is certain that you are going to pay penalty. So that is adjustment to transaction. Not only that, another example. Again, retail. Okay. If you go to any retail supermarket today, you will find a lot of advertisements at the beginning of the shop. For instance, beautifully chocolates will be arranged whenever you go to shops. Do you think it's a coincidence? Very planned, no? We all know that it's planned. For that, retail is going to get some money. It is called slotting fees. But who is paying the slotting fees? The product seller. Normally, if I am running a retail shop, I buy goods from whom? From Cadbury, for example. But that fellow is going to pay money for me for putting the product in front of his shop. So, normally customers, he's a supplier to me, no? Cadbury is a supplier to me. I only have to pay him money, but he's paying money to me. So the question is, if he's paying money to me, what should I do with that money? Should I say it's my income or it's a reduction of my sale price? Standard says it's a reduction of your sale price. Because there is no distinct service or good for that particular, you're not in a business of, again, goes back to the customer definition. Guys, I think that's why I discussed the fundamental concept first. You are not in a business to do advertisement. Your business is to sell goods. But you are putting the slotting fees, you are collecting for a slotting fees for the same product. So you actually have to adjust it from your revenue. It's not your separate income as such. So that's another concept. I think that's why transaction price determination is important. Because again, this is more, it will affect retail segment, to be honest. Like I think transaction price to performance obligation is what we discussed. Whatever bike example we said we should allocate, that is allocation. Once you have control as a, once you pass on the control to customer, then for which performance obligations you pass control. In step 5, you recognize revenue for those performance obligations. Like AC example we discussed. If AC is delivered, take revenue for AC. If installation is done, take delivery for installation. That's it. That is the standard. That's it. Five step model over. So very easy, no? Actually, the problem is the complexity of the business. That is where you'll have judgments, etc. So five step model we discussed, in a elaborate fashion. What we will do, only five concepts I will discuss in the session. So we will talk about identification of performance obligations. Step 2. We'll go in little more detail. There we will spend some time. Then there is something called point in time and overtime concept. You remember we discussed about series of distinct goods and distinct goods. We said construction has a lot of related activities, repetitive activities, but only one performance obligation compared to some 10 different products that retail company sells to its customers. Then all 10 are different performance obligations in that example. How that will change the revenue rec, that will come usually in step 5. That one concept we'll discuss. Principal versus agent. When you will become principal, when you will become agent. That is another topic we will discuss. That comes in step 2 only. Transaction price adjustment, whatever examples I've given, probably some more examples we'll discuss. And there is one interesting concept in Ind AS 115 called contract costs. So what is contract cost? A lot of people don't know this. Usually we all look ways and means to spread the cost across period as accountants. I mean, auditors will discourage, but accountants would want to do it. This is one way of doing it, contract costs. So very, very interesting concept. If you actually have a lot of costs which you pay to acquire a contract, you have an option to defer the cost over a contract period. When we can do and all, we will learn. That is one interesting topic. These 5 topics only I want to discuss. Then I think we can, with that, we can, if you have any questions, we can take up. Otherwise, we can end the session. So first, let me talk about identification of, since we discussed all the steps, so we'll talk about performance obligation identification, right? So performance obligation can be both. It could be through a distinct good or service, or it could be a series of distinct good and service. We understood the difference between both, right? Distinct good or service is our example of whatever we spoke about, any product. It could be apples, mangoes. Individually, you can benefit from each of these products. Or if you go to retail shop, every cloth that we buy is a distinct good and service. You can use it on its own. Series of distinct good and service, we discussed examples, cleaning activities, construction activities, hotel management service, another distinct good. If you, for example, we see a lot of PGs, right? Paid guest house, someone has to maintain it. So a lot of contractors would take that job also. But there are a lot of activities you have to do. It's not one activity or two activities. For that, you charge some fixed fee, say 5% of the rent, whatever, right? So there also you have series of distinct good and service activities. So in both the cases, you will have performance obligation. So then what we are trying to say is, uh, once you determine the performance obligation, okay, there one more factor you have to consider, which is not in the contract, could be customary business practice. Um, how many people have pani puri here? One. Okay, super. 3 people have pani puri. 4, very good. So I think in Vijayawada also they do it. At the end of the pani puri, you'll have pani puris, right? 10, whatever, right? Towards the end, what do they do? With masala, they give an extra pani puri. No? Huh? We think we pay only for 10, but we are paying for 11th one also. Okay. That's usually the trick, right? That is customary business practice. Just imagine a company doing it. Company also does it a lot. Buy two one, get one free. How many offers we have seen? Then we buy the product. And then they are just simply spreading the cost across three products. They are not doing, they are not giving anything. Nothing in this world comes for free, no? We all know that, right? But we still believe that we buy, that is different. Now, why we are discussing that is customary business practice is something which you don't put in the contract, but you give it to customer. So there are a lot of companies actually who take up service component, which is even though it's not there in the contract because they want repeat business. For example, you go to a hardware shop, you buy a hardware product. He is not going to give you any warranty on the record. But if for in good faith, he will if you bring the product back to him, lot of shops will repair and give it to you back without charging money. So if companies are doing it, if there are established customary practices in that industry, you have to take those also as performance obligations. So warranty, if they are really doing it and they don't put it on the contract, just because you don't put it on the contract doesn't mean that you will ignore that performance obligation. But identifying that is very hard for us. We audit, we have to ask all these questions. We have to look at the costs. Suddenly, some new cost will come. Then we'll have to ask, what is this cost? Why are you incurring? Then he will tell you that guy has come. He's doing servicing. Acha, if he's doing servicing, then why are you not collecting money for this? Because I'm only able to see product revenue. I'm not able to see any other revenue. Then he will tell you, no, it's usually our practice. That's sufficient for us. Then we can do what we have to do as per the standard. Okay. So that is customary business. Contractual terms we know, we discussed. As per the contract terms, we'll identify. So marketing incentives also we discussed. Whatever free service, RSA, warranty, all these will come under marketing incentives. Right? So now we'll go into a level of detail in performance obligations. So for you to call something as a distinct good and service, and also to say that uh, it will also become performance obligation. Step one is the good should be capable of being used on its own. The second important concept, which we did not discuss, okay, how it is distinct in the context of contract. Both conditions, if they satisfy only, it will become a performance obligation. We'll spend time on second step. First step, we already know. We already discussed enough number of examples on step one. Just remember, both the steps are also important to call that as distinct good and service. Both steps automatically will also make it a performance obligation. So it's same, no difference. So for step two, what we are trying to say is, this again goes back to what is the final delivery that I'm going to actually give to customer. Let's take another example. Now in Vijayawada also it is happening. Lot of companies, lot of people who want to construct the house, they are going to consulting agencies who are also coming up with construction options. So they are telling we will design the house like this. Everything we will do for you. Construction, everything they are doing. Okay. So they are helping you start first to they'll show you how beautifully the house will look, and they will help you to buy those materials. They'll construct everything they will do for you. That's the kind of product offerings we have. It's there in other cities, it's there in Vijayawada also. So then the question is, can I say design and construction are two different performance obligations? That's usually the standard question that will come there, right? Apparently there are two. There can be multiple, but usually there are two. Step one, mostly if I go with one level, you can always say I can get design done from someone, construction done from someone else. We might think we might come to that view. Quite possible also. That is where step two we need to see. What is the context of the contract? Again, when I come to you, sometimes I come to you not just for design. I trust you. I want you to take up the entire activity. That is why I'm coming to you. Or I can also come to you for design. But the intent of the party is important. Why he is coming to you? That's the context of the contract. The context of the contract sometimes can be both design and construction, which are inseparable. I'll tell you why sometimes they can be inseparable because you started designing. The guy started designing. He came to you with design. You approved the initial design. Then they started construction also. Then you felt that this bedroom is probably not coming in the way you wanted. Then you'll say you change the design. Of course, they know the cost considerations. They'll say this is additional cost and all will come. Again, they will change the construction. Like that, iterations can happen. So there is a very high level of dependency between design and construction in those cases. So the context there is it's a combined output. It's not single output. In fact pattern, there can be another fact pattern where you just give me design blindly. I'll take some other fellow. I'll get it constructed. You need not interfere. Don't worry. Your job is done. Thank you. Bye bye. He will still be there. That's okay. But it's nominal. Some other person only is doing construction. Same company. Both people are from the same company, but that doesn't matter for us. Their design and construction might be different. But in the other example, if there are a lot of iterations, this will more happen with costlier houses. The more costlier the house is, more chances that it will fit into one performance obligation and not two performance obligation. Now, this is true even for a lot of software's installation also. We know all SAP, right? SAP is a standard software, but a lot of, and I'm sure you also know it, companies spend crores of rupees for installation of SAP. Now, if SAP itself is a costly software, why should I spend money on installation? The reason for that is every company has a different model. Every company has different type of corporate structure. So you have to do significant amount of customization in SAP. There, what happens? Lot of times the software is so closely integrated that you can't separate one from the other. So there are cases where those cases it will become one performance obligation. Sometimes companies go to outsource software companies and say, you give me a software and also suggest me the hardware. These are the things that I want in the software. They give hardware, they also give software. But that's a very customized product. There you can theoretically split software and hardware cost. You will get the bill. If you are asking questions correctly, you will know that it is single performance obligation because they are inseparable. Standard gives guidance there. Standard says you when you get the contract, see the context of the contract. Are we talking about two highly interrelated, interdependent inputs and outputs? Then you cannot say it is a separate performance obligation. You have a single performance. So that is the concept of step one, step two. Okay. So again, step two will only clarify whether it is single or multiple. At the end of the day, the problem that we are trying to solve is we are trying to solve how many performance obligations are there in a contract. That is the problem we are trying to solve. Simple. Okay. If there are two, then you have revenue recognition also goes twice. If it is one, you have to wait till the performance obligation completes. But we will discuss in step five how we should recognize the revenue if there are a series of distinct activities because there you cannot wait for the entire contract to complete. So we'll come to that. Okay. So that is on performance obligation. Okay. So here if you see, I mean all the examples we discussed, there is nothing new here, but you want just to read the slide, just you can spend a minute on the slide. This is the first equipment example, we already discussed that. And if the same equipment installation are highly interrelated, the other example I've given. Right? So there it becomes one contract, not two. And not one performance obligation and not two. Again, installation can be provided by multiple vendors, so it's distinct. But then if there is a highly the customized software example. If I know what I am building, I only know what hardware configuration is required. He will not be able. No other person can come and do that work. So that is the case. Maintenance. So maintenance is not usually highly interrelated, but you will have a series of distinct different activities. So this example also we discussed. Okay. So the first concept, identification of performance obligation, we discussed. Any questions you have on this topic? So then we will talk about principal versus agent. Then we will move to transaction price adjustment examples after this. So principal versus agent. I recently wrote an article in Vijayawada chapter on this topic. Probably you can see this month newsletter you have. I've given elaborate guidance also on this. But I think in simple terms, what simple principal agent is trying to do is this is basically a fundamental thing which everyone will try to play around. For example, if we face lot as auditors on this topic because I work in Chennai where completely it's manufacturing. So there is a lot of contract manufacturing that happens in Chennai. So if you know contract manufacturing business now, it's the talk of India, not town in the sense because now India is a lot of employment that India is getting today is because of some of the government schemes like production linked incentive PLI, which goes in manufacturing sector. So what people are doing is if I have a product, for example, I'm Apple, I have a lot of products, right? Apple never manufactures a phone. Lot of OEMs they don't manufacture by themselves. Their main focus of energy is to I understand what customer wants. It's all the business is very different, right? We think the business is different, but actual business is different, right? Every OEM's target is to understand the customer pulse. But for every OEM, customer will be different. For Apple, they will go after premium segment customers. If there is some OEM like Sony, they also go premium. For example, if there are Chinese companies like Xiaomi or Oppo or all, their segment is mass market. Everyone will try to study the pulse of the customer. After they study the pulse of the customer, they will say these are the features that I want for my product. Then what they do is they go to contract manufacturers. Most likely, some of these companies do R&D, do a prototype of the product, and then they go to contract manufacturers. Now, even the prototyping also is getting contract manufactured. That is different. So now everything can be outsourced. Designing also can be outsourced. Today, the world is so advanced. For example, there are companies in India who take up design outsourcing. If you know Dixon Technologies, it's a listed company. They take design outsourcing. And there are already established players in the market like Foxconn, Pegatron, all of them do design outsourcing also. Now, the key point here is it's not your product, but you took up design. It's not your product, you take up manufacturing also. So, the job of OEM is just to create market. They do advertisement, they do R&D, they are fully into marketing. They identify the distributors. They create a kingdom of marketing everything, and they'll say, boss, you are contract manufacturer, this is prototype, now manufacture. That is the business. These kind of industries are there. And we already know our traditional trading business, right? Distribution business, where your job is you buy from the wholesaler, sell it to retailer, in between you are there in the chain. In all these cases, one common feature is what is your role? Are you a principal or are you an agent? If you are a principal, you will record full revenue. If you are an agent, you will only record commission revenue. That's the key question here, okay? I can tell you that this problem is there in every sector. Pharma sector also, there is a lot of contract manufacturing. The situation is so bad that auditors are revisiting positions that they have taken after 5 years. I told you at the beginning, right? This standard came in 2017. Everyone is applying this standard from the past 7 years. But people are, it's taking time to sink the real principles of the standard. More people understand the principle, they are going back and challenging their positions. I know few clients coming back to me and saying, Virinchi, you guys only have taken this position. 3 years later, you guys are only saying that this is wrong. Now we have to change. Now, what do I tell the investor? Because we already projected revenue, this much amount of revenue we showed the investors. We said that to bankers also, we have submitted projections on this basis. Now, what do I do? These are real problems. But what I am trying to say is, from India's perspective, the principles have always been clear. What India says is, if you are a principal, you have to take ownership of the product in all respects. I mean, I'm just using layman terms. We'll come to technical terms, okay? The difference between an agent and a principal is principal takes ownership of and responsibility for delivering the product, and it just does not arrange the product. So, if we talk about commission agents, for example, lot of times commission agents also take responsibility for product delivery. I'm not saying no. but their ownership is not very high. For example, if there is a problem with inventory, they will say, boss, you go and talk to supplier. I ensure that whatever quality you asked, you got. You told me this is the grading specification, I've got it for you. Now, if there is a quality problem, why are you coming to me? I have not manufactured this. That is what an agent will do. But if you are a principal, what principal will tell you is, okay, yeah, there is a problem. I should have checked the quality. Okay, let me see what I can do. So you have to compensate the customer first for the loss. And then you fight your own game with your supplier. Now, how much supplier will give, you don't know. He might agree or he might disagree with you also. So you are taking more risk. That is when you become a principal. In simple terms, this is the story. Same principle applies to contract manufacturers also. Lot of times what happens is every company, no company exactly knows how much product will go to the market. Everyone will work on demand schedules. So for example, if today, say there is Samsung, okay? You know, right? Samsung product is used to be a very premium brand. But now Apple is trying to eat away the market share of Samsung. If you know, you closely buy mobile phones. A lot of people have Apple iPhones, right? 12, 13, 14, 15, everything they are buying. 16 comes, that also will sell in India without a doubt. So the demand, how much I have to manufacture. If I'm the contract manufacturer, I should get a direction from my customer that this is the demand, right? So the typical contract manufacturer works based on demand schedules. So he will get next 6 months demand. Based on that, he need to plan his procurement. In India, if you are manufacturing any kind of electronic product, usually 50-60% of the material will be imported outside India. So if you follow the global economics, none of these prices are stable. If Ukraine war comes, you will not know whether you will get certain raw materials or not. Highly unstable. When Corona has happened, none of the companies have got very precious materials like chips. Mobile phones, laptops had no issues because they are most profitable products. So chip companies are very few across the world. Okay. So easily they used to get. But other sectors like automobile industry used to suffer a lot because they don't pay that much amount of premium which mobile phone users can pay. So they have not got chips on time. All of their production capacities got stopped. Even when there is demand, they were not able to supply for 1-2 years. If you are someone who would have applied car in 2021 and 22, you will know the pain. People have taken 6-7 months of waiting time, even 1 year for Mahindra product, for example. I know some of my friends who postponed their purchase decision because they only want Mahindra. Some of them said, I don't want these many features. I will take some feature which does not have any kind of electronic features. So now coming back to principal agent, the main challenge is if I am a contract manufacturer, I will procure a lot of goods in advance because I know this much demand is there and next 6 months this much demand will come. I have to plan my production today. But after 6 months, if OEM tells me that this much demand is not there, what do I do with all this stock? Now, if I go back to contract manufacturer OEM, then he will say, did I ask you to buy? I have given you 6 months schedule only. You only went and overboard bought some other raw material. How am I responsible? You are stuck, no? That is principle. But if you strictly buy based on demand, whatever happens, happens. I'll also get my money. Contract manufacturers, life is very simple. 100 rupees I spent, I get 3% of 100 or 5%, whatever it is. That 5%, 3% is my margin. But my volumes will be very high. So I'll recover all my cost in few years. Very good business. Contract manufacturing. But the problem is, which category are you in? Will decide whether where you are principal, where you are. I mean, this is just one simple example I've given. There are a lot of other risks which we will discuss in principal. But the key risk is he is putting his skin in the game, right? He's taking a lot of risk, inventory risk he can take. He can take the responsibility to handle the product quality. For example, if something goes wrong with the promise, are you taking or back to back you have production with your supplier? That also will determine what is the level of responsibility you carry. And other important thing is pricing risk. So three risks we will speak in principal here. Inventory risk, pricing risk, and performance obligation risk. Meaning, if something goes wrong with the product, how much responsibility you're taking. That is the main thing. Inventory risk, whether it's yours or not. Pricing risk. Pricing risk means usually contract manufacturers will not have much pricing negotiation. Commission agents also, for that matter. You can only bargain on your commission. You will say, I want 2% commission, I want 1.5% commission. Now, the supplier can get 10%, 20% margin also, but you can't negotiate on that. For example, if I manufacture the product, I know the product cost is 10 rupees. I am going to sell my customer at 50 rupees. Commission agent can only say, okay, I want 3% commission. But he cannot sell the product in the market for, say, 60 rupees or 55 rupees. He has to listen to his OEM. He might have some flexibility sometimes, but the price, how much he can control will be very less. So those are the indicators that he's an agent, right? Usually the underlying principle is if you are a manufacturer, 99% you might be principal. Because all OEMs, wherever they manufacture, they only take all these risks. They will only determine the price of the product. They will only have inventory risk. They are only responsible for the product quality. So usually manufacturers is no brainer, but because of this contract manufacturers coming into picture, it has become complex. Not every contract manufacturer will be principal. There are a lot of contract manufacturers who are fully protected by their OEMs. They will say, you will not take any risk, boss. You just have to replicate this prototype for me and give me. No risk for you. Those kind of contract managers are also there. There I will not allow gross. There it is net only. Even if you do 10,000 crore turnover, still you will only record the difference between purchase and sale as your, that's it. I mean, we usually deal with these kind of cases, so it's very interesting for us. I'm not sure how much interesting it is for you, but we spend a lot of time debating on these cases because we have very hard time convincing our clients to, because we go technical, they go business. It's very hard for them to put in their mind that okay, this is all right. You are still earning a lot from revenue standpoint, but you are not entitled to it. It's very hard for us to explain this kind of nuances to them. So, but it is where it is. So, one interesting example that is given in the standard is travel agency, right? Here also, I'll explain both the sides. How many of you know private jets? You heard about private jets, right? All of you would have heard. And we all know about Yatra and these kind of companies as well. You know, this Go IV Go, Make My Trip, all this. So usually, lot of these companies, and you might be knowing this already, Make My Trip or Go IV Go, they don't purchase airline tickets. They just put the availability of the tickets on their website. They don't do crap. They create a beautiful website for us to come there, place the order. We are only buying from the airline. So none of us are interested to go to airline website because we want all options to be in front of us. Of course, a lot of people still take Indigo, but I'm just saying Indigo, Fisher, Tata Vista, every option we want. Or even if you are taking a bus example, the same thing. Every bus service provider, we can book in Make My Trip, right? You have 10 options. But none of the case, the travel agency books the tickets. They just display the availability of their website. You only go and book the tickets. That is subtracted directly from the availability of the traveler danger of the bus itself, not with the agency. Yeah. Would you say that the travel agent is a principal or agent? Agent? Any other thoughts, madam? So, yeah, it's agent because what he's doing, he's just putting availability on the website. Now, the new norm in India is if you are ultra rich or super rich, private jets. So, what they're doing, they will charter an entire flight, an agency. They only work for rich people, okay? They buy all the. They don't own they don't own the private jet. They take the private jet on lease, say for 1 month, 2 months, or they book the tickets for the entire period, and then they take the inventory risk. Then they go and find customers. So if suppose a lot of people don't take private jets, what will happen? Who has to bear the loss? This fellow, So he's taking risk. If you know, when World Cup final happened, there is a mad rush for everyone to go to, Ahmedabad. Very surprisingly, the highest number of private jets happened to be from Hyderabad, not from Delhi, not from Mumbai. So we are, I know this is Andhra Pradesh, but still going back to the place where Andhra and Telangana are one. So Hyderabad is the richest in that manner. You see, a lot of private jets are stationed in Hyderabad. So the principal agent concept in travel agency, most of the travel agencies are agents by name itself. But there are a lot of travel agents who also charter bus. For that portion alone, you can do gross. You can, you will do gross. There is no. If you are a principal, you should account gross. If you are agent, you should account net. You cannot take via media positions, which can be contract specific, right? That is an example. Simple. So again, this is coming under step 2, determining performance obligation, because one of your performance obligation can be an agency performance obligation. So that's why this is coming under this header. Okay. So here the performance obligation is arranging travel ticket for someone. It's a performance obligation, but you are not giving a travel ticket. You are arranging for the travel ticket. So performance obligation is only commission for the travel ticket, not the revenue from the travel ticket. That is what we are clarifying here. Okay. Right of return consignment arrangements. Again, very simple. Okay. Complex because of judgment involved. Simple understanding. Okay. So we all purchase products from Amazon, right? Have you ever seen return policy of Amazon? Lot of Indians take left, right, center advantage of it. We take the product, we use it for 1 week, and then we return. Okay. Don't worry, not just India, outside India also it is like that only. I know a lot of people do it in the US also. They buy a product, they don't even take the tag out. They use it for 1 week and they return it. There are people like that doing in the US also. So right of return. Okay. Now the question is, a company which is selling 1 crore of goods every month, if they give a right of return for 15 days and they keep doing it like that, how can you be sure that 1 crore is going to come to you? Can you record 1 crore revenue when you have a right of return? So you have given a 15 days right of return. How should I record revenue now? Should I wait for the 15 days to complete and then record revenue? Or should I record revenue? What are your thoughts? It's a practical issue, no? Excellent. So basically, you have to form a judgment. If I have, and this judgment is for one company, for one product. It's not, you cannot take some overall percentage at all. That's why it is complex. And it is seasonal also sometimes. Because in certain markets, certain seasons only products will sell. And certain place, simple AC. We all buy ACs in summer, unfortunately. In winter, price will be low, but we will not buy. We'll buy only in summer. Even umbrellas. Only rainy season we'll buy. Then only we'll remember about umbrellas. In summer season, summer also people take umbrellas for different reasons. But I'm just saying, lot of judgments are there in estimating the percentage of rate of return. But the concept of rate of return is straightforward. If you have rate of return as a feature in your contract, you cannot take full revenue. There is a variability in your revenue. So you have to estimate that variability. That itself is a transaction price adjustment. So if you look at any product that is supplied through Amazon, so Amazon again does crap, right? They just create a beautiful website, everyone come and buy. Okay. But all suppliers of Amazon are forced to give right of return. Sometimes what Amazon does is it will take right of return responsibility. It will assure your suppliers, the supply, no, if there is a problem, I will bear the cost. Both models are there. It all depends on how they want to promote. They will run a lot of promotion schemes, Amazon. But the point here is in your if you are auditing any company, in that contract, you should know what is the risk your company is carrying as far as rate of return is concerned, and then it has to be adjusted to transaction price. This is not a separate performance obligation. Performance obligation means I need to perform something. Here, there's nothing to perform, but it's a loss that you might have, which you should estimate upfront. This estimation will give a correct picture to investors that okay, this is the correct revenue. All this why we are doing is just to protect stakeholders. Stakeholders can be anyone, can be your banker, it can be your investor. Just don't forget that all these are applicable for a practical purpose. It is not theory. I'm telling you personally, I have audited a lot of companies and we made a lot of these adjustments. Management cried, shouted everything they did, but we made the adjustments. We ensured that these adjustments are done, whatever the case might be. At the end of the day, um, it's all about transparency and accountability. So that is what we have to ensure. Consignment arrangement, again, see, I think this is more linked with control. I think we already discussed the concept of control. Whatever is the consignment arrangement you are having, again, look at the contract, who is having control, when they have control, and then determine the timing of revenue recognition. As far as principal agent is concerned, we already discussed three factors. But just remember for principal agent, before we just cross principal agent topic, if you are already controlling the product before you transfer to the customer, you need not look at the three factors. You can straight away take principal position. Only you when you can't conclude that, and a lot of cases you will not be able to conclude. It's complexities. If it's a own manufacturing, there is no issue. That's why if that kind of comfort you don't get at the beginning that you are controlling, then you should look at those three indicators: inventory risk, pricing risk, and primary responsibility for fulfillment of the order. Those three things you should see. Okay. Principal agent we discussed. Transaction price adjustments. We discussed right of return, that is transaction price adjustment only. Let's look at some of the transaction price adjustments. So we'll just discuss some core concepts in transaction price adjustment. Let me just stop here. Am I boring you? Are you okay to you want to take a break like 5 minutes or so? I'll just stop. I have no problem. Otherwise, I'll continue. Excellent. Okay. So there are four different types of adjustments we will discuss. Okay. Variable consideration, significant financial component, non-cash consideration, and consideration paid or paid. All of them are very interesting concepts. I can tell you that. Okay. I'll start with my favorite one, significant financial component. Again, what is the context? The context is you sold goods. We are all trying to determine what number should actually be recognized as revenue. We all understood about different promises. We all understood about uh, when we should recognize revenue, when the control is transferred. We know the fundamentals. Now we are trying to determine what should be the value that should be subject to revenue recognition. In that context, we are talking about significant financial component. What is significant financial component? Very simple. We all buy products from Bajaj Electronics, 1 rupee scheme. There are ads for running for a lot of time. 1 rupee you pay and take the product, all those things. Bullshit it is, okay, but it is there, okay. Um, so Bajaj Electronics, or for that matter, any kind of company will give you products in installments. 1 lakh product, 10,000, 10,000. They say zero EMI. And they also say zero interest. Okay. I'll only ask one question to you guys. When you pay takes, I'm not discouraging. I also taken on Bajaj for 3, 4 years. I'm not saying it's not taken all. Did you ever compare a standalone price of that product to the market and check if there is a difference between what he's offering to you and what you can get if you don't go with Bajaj? Have you ever checked? I have checked. I can tell you that there is a minimum 5 to 7% variation in the price. For instance, if you take an AC, you go and buy in Bajaj, vis-a-vis, you go to a shop directly and negotiate the price, minimum to minimum, 7 to 8% you will save. Why? Because he's offering you to pay it over time. There is an element of interest involved which is loading in the sale price. That is financial component. What standard says is very simple. Okay. Say Bajaj example. Say AC costed 50,000 rupees. You said I'll pay that in 2 years. That's why it is 50. And he will charge you a transaction fee of 5%, some 2,000 rupees and all he will take. That is also interest only. He's just collecting the interest on day one. It's also fooling us, basically. That it's not transaction processing, it's interest. Upfront is taking Marwadi, proper Marwadi business is doing, basically. Okay. So what we are trying to say there is, if this 50,000 product, if I straight away go and try to buy in the market, how much I will get the price? Say it is 45,000, just for our discussion purpose. Then what standard says is, boss, please recognize only 45,000 as revenue. This 5,000 rupees, which you fooled public, this is interest. Recognize that interest over time. 1 year, 2 years, whatever it is. That is segregating the transaction price. Don't forget that there is no separate performance obligation here. Performance obligation is still the same. Only one performance obligation. What it is to supply the product. You have already done it. Now we are only discussing how to recognize revenue there. So there what we are trying to say is upfront whatever you are recognizing, that only should resonate the actual price of the product, which is 45,000. Balance 5,000, you should that is your interest income. Interest income you should be recognized in accordance with IFRS 9 or Ind AS 109. So there is a different approach. So actually speaking, IFRS 15 or Ind AS 115 will interact with other standards. But how you should recognize that interest is given in 109. Again, just to avoid complexity, in simple terms, you will do the present value calculation, assuming an implicit rate of return. So you will go and inquire in the market. Usually they will say 12%, 10% will be the product financing interest rates. You will take that interest rate, discount it to present value. Difference amount is taken as interest. Using EIR method, you will recognize the income over 1 year, 2 year, whatever. And the remaining portion, revenue. That is significant financial component. Simple. Okay. Non-cash consideration. Not very complex. For example, if you are getting something from the customer in kind, determine the fair value of that particular value and adjust it to revenue. Non-cash consideration. I'm just trying to think examples, practical examples. Huh?
Second-hand car.
Yeah. Second-hand car is an example. Because you are taking something in kind, phone everywhere you do that, right? So that is a non-cash consideration which you should adjust in the sale price. That's a perfect example. Consideration paid or payable to customer. I've seen some of these cases also practically. Sometimes what happens is there will be cases where uh, customer can be your vendor for various reasons. Okay. So, for example, if your company is an FMCG, the company that you are doing business with is FMCG. For example, is your customer also. There are chances that you purchase from that company as a corporate. As a corporate. Example, say Samsung. You went and doing some software, you're a software company, you're doing some services for Samsung. So he's your customer, simple, right? Same Samsung, you strike a deal with him and said, I want 1,000 mobile phones. I'm planning to give mobile phones to all my employees. I'm your vendor. Show me some mercy, give some discount. You have asked, you strike in a deal, everyone is happy, got the money. What regulator says is all that is okay, your good deals and all you are doing. What I will do a check at that stage is I will try to see whatever fair value that you are buying, right? Whatever mobile phones that you are buying, is it a representative of that mobile phone value or not? Or are you doing anything hanky panky to affect the sale price of the original goods that you sold to them? So there is a sense check that is prescribed in the standard. If it is a distinct good and service, if your price that you are collecting exceeds the fair value of that particular mobile phone, which means the other sale consideration, something is wrong with that. That sense check you are supposed to do before accounting. That is the guidance given in the standard. You can also, uh, you would have also paid to customer because of other reasons. For example, if sometimes what happens is there are certain jobs that you will do with customer support. So, for example, if you are in the business of again doing some service and you need a large space to do that particular job, which otherwise you should do it in your godown. But customer said, okay, you pay me some rent and you do it in my godown. Everything is available here. You get your materials, but I'll charge you for using the mobile warehouse. Otherwise, I would have given on rent. So there, one end you are getting money, you are also paying money. In those cases, you should adjust it from the revenue. The difference between the first example and second example is, in the first example, the product which you are actually supplying to customer is different from the product you are buying from the customer. What you are supplying is software. What you are buying is mobile phone. So it's a distinct good and service. So adjustment is not required unless there is a problem with fair value. But in the second example, for doing his work only, you are paying money no to him. So standard says you should definitely adjust for the same service. Of course, you can argue that I would have gone to some other warehouse and have done it, but you have gone to the same warehouse. Why they are doing this is standard setters did not trust to take risk with this kind of transaction. They said you adjust and keep. I don't bother. You reduce from the same instead of showing it in cost, you reduce from revenue. Well, I don't know whether your fair value is correct or not for determining the rate. So that is the sum and substance of consideration paid or payable to customer. Then the first one is variable consideration. This variable consideration itself will have all this bonus, refunds, all these things, incentives, penalties, discounts, liquidated damages. Anything of this sort comes, adjust it in the revenue. If you look at some of the companies give price protection mechanism. If you, for example, if you remember, I think again when COVID almost is passing, people understood that prices are going to increase. So what the OEMs did is they offered price protection schemes to its customers. They said, you book the vehicle now, after 2 months you take delivery, no problem. Price will remain this one. That is because they knew that after 2 months raw material prices are going to go up. So they tried to hedge the risk. They said now only you take the booking. A lot of customers took the booking. But what happens is raw material prices will increase eventually. So my sale price to dealers automatically go by my own costing. So dealer will collect less from customer and take more hit. So that time we will compensate the dealers. My revenue should then be less because I compensated dealers for price protection. So I will adjust it to revenue. So that's how it is. So that's it. That is on transaction price adjustment. The last concept for the day is contract costs. Very interesting concept, which is not there in normal IGAP. This is there only in Ind AS. So it is also there interestingly in IFRS 16 or Ind AS 116, which is lease standard. Okay, it's there in both the places. So what they are saying is the incremental costs of obtaining the contracts and the costs of fulfilling the contract can be spread across the contract period. That is the sum and substance of the standard of this particular item in the standard. So what they are trying to say is, for example, simple example we will take. We all pay brokerage for rent, right? So a lot of us, if we change the house, sometimes it's very difficult to find a house. That brokerage that we pay, if it is very high, for corporate companies also, there is the same problem. But that is paid for lease. It comes under 116, but relatively same concept under 115. Whatever brokerage like that you paid for getting a lease, you can also pay brokerage for getting a contract today. Officially, not bribes and all. Okay. Bribe means I don't know how you'll record. That's different. Okay. I'm not talking about that. Officially, you can appoint agencies and you can ask them to find customers. It's legal. There is nothing wrong about it. And they find customer, you have to pay them. And if that customer is a long-term customer, for more than 1 year, if you think the benefit will come, standard will say if there is a lock-in contract with a customer. For example, your broker got a deal for you, you are manufacturing your product. 3 years he agreed to buy from you, and you paid a very big brokerage to him. Then standard will say, okay, you first expect how much profit you are expecting from this 3 year contract, you calculate. Say you are getting some 5 crore benefit. If this cost you pay to broker is more than the 5 crore, then you cannot, then you should expense off. But if it is less than that 5 crore, then you spread that cost across the contract period. So for instance, you paid 50 lakh brokerage and you expect 5 crore profit to come in 3 year time frame. No problem. Spread this 50 lakh for 3 year period. But if you pay 50 lakh brokerage and the profit you are going to get over 3 years is only 20 lakhs, then standard setter says you have already stricken a loss contract. Should immediately provide for the loss. 50 lakhs you provide immediately. The 20 lakh also you have to provide under owner's contract assessment. That is different. But brokerage you cannot capitalize in that case. So that is cost, incremental cost of obtaining contract. The other thing a lot of people usually ask when I explain this concept is to me, they'll ask, Virinchi, we have a lot of people who have sales department salaries and all are there, right? Can I capitalize sales department salaries? They will ask. This is a very, very specific assessment. It starts with the word incremental. Salaries you will pay whether you get contract or not. So those kind of comedy you can't do under the standard. You can only capitalize incremental costs. Say, for instance, slightly if I take a different fact pattern, you told to salesperson that you go and win the contract, 5% of the contract is your bonus, go. We told him. If he really gets that contract and same condition satisfied, then you call capitalize, no problem. Instead of paying to a third party, you are paying to an employee. But as an auditor, I'll be more skeptical. I'll look at facts more clear. I'll try to validate if this is right or wrong and all. But sum and substance, you can argue technically that you can calculate that cost. It's allowed. Cost of fulfilling the contract. Relatively, slightly different, but again, coming from the same thing, okay? For fulfilling the contract, sometimes what happens is you have to incur some big fixed cost initially, setup costs, only for the contract. But the benefit of it will be realized over more than 1 year period. In that fact pattern also you can capitalize. What example? If you again go to automotive industry, these service providers who take up all these RSA contracts, roadside assistance contracts, or your servicing contracts, because someone should service your vehicle. No, I know usually a lot of us go to authorized dealers get a vehicle serviced, but there are a lot of other players also. Like TVS is in this business from a long time, and a lot of other players are also there in this business. So sometimes what happens is if a customer comes, like someone like a Honda, comes and says, I don't have any service touch point in Shimla. Can you set up? Then what this fellow will do? He will build a base for this OEM as a service touch point in Shimla. The contract is a 3 years LBU contract. Whatever vehicles come for servicing, this is your fixed fee. So this fellow will do his math. He will negotiate and say, okay, I can survive this. He will agree the contract. But for setup, it will cost him a lot. He has to pay a deposit. He has to construct that entire place, and he will incur a lot of fixed costs. Standard says, since you are constructing it only for this customer purpose, those fixed costs you can amortize over contract. Like for example, you paid brokerage to get the premises there for rent, or you have done some setup costs, one-time costs. Identify those one-time costs. Again, regular costs you can't capitalize. Those costs you can take it over contract. So that is fulfillment costs basically. Again, here two main principles is they have to be very specific to the contract. They have to be incremental. These two are important. If these two conditions are satisfied, then capitalize, no problem. So that's it, guys. I think these are the core concepts, in the standard. See, I think uh, overall standard still has these 5 steps. We discussed these 5 steps in uh, probably 1,000 feet level, and we discussed specific concepts. So if you see what we discussed, we first spoke about who is the customer. That will help us to identify step one, who is the customer, right? Contract, I didn't discuss too much about the contract because usually we are all professionals. We know when we look at the contracts, we know what is enforceable and what is not enforceable. So that's why I have not gone much into contract and nuances, right? Then we spoke about identifying the performance obligations. We spoke about the concept of distinct good and service, and we spoke about, I think only one concept that is left is point in time and period in time. That alone I'll cover some 10-15 minutes. Otherwise, everything else is completed. Then we spoke about determining the transaction price, where we spoke about discount schemes, variability related stuff, and all right of return. All those things will come under transaction price. Then on allocation, we didn't discuss much because see, a lot of examples we discussed. Once you know your performance obligations, most of the times the contract itself will have separate values for each of these performance obligations. Sometimes it will not have. In those cases, you have to go outside the market and see how much this person is charging if they provide the service independently. For example, same RSA. If I have to estimate in 1.5 lakh rupee how much RSA will cost. If I take this service from outside, how much RSA premium I'm going to pay? Policy, 1,000 rupees, 2,000. That assessment is called standalone selling price assessment. If I were to take that service independently, how much it will cost? That we will use like a pro forma price and then identify it with the main contract value. So that much amount we will not recognize revenue till the time the performance obligation is not satisfied. Okay. The last concept is recognizing revenue as and when performance obligation is satisfied. This goes with control concept. Whenever you supply the good, once control is done, you will recognize revenue. The only concept we did not discuss, which is very important, is point in time over time. That all we'll discuss and we'll end the session. That comes in step 5, last step. Yeah. So again, let's go back to the old example. Series of distinct good and service and single distinct good and service. So there we said series will have activities like cleaning service, hotel management service, construction service and all. So if you look at these 3 conditions, what standard says again very simple. Okay. Anytime when we recognize revenue only when control is transferred. Okay. But there are certain activities where activities happen throughout the period of the contract. The question there is till what time I can wait, not recognize revenue. That time will be very long sometimes. So you have to then form some other way to recognize revenue, like for example, percentage of completion. You have to be able to form a different perspective on how you can recognize revenue. But for that, you should be able to fulfill certain conditions to recognize revenue over time. Point in time, over time. The main difference between point in time and over time is point in time means exactly after that point only you will recognize full revenue. Over time means throughout the period, you will put touch points and you will recognize revenue like monthly, quarterly. For example, cleaning services are usually whenever the invoice comes monthly and all, you will recognize cost. Or if you are the company, you will recognize revenue. That's why it is over time. I'm just explaining the concept without discussing the conditions. We will discuss the condition, but I'm just explaining without that. So point in time means after the good and service is supplied, then you will recognize revenue. Over time means as and when the service happens, you will have a touch point, monthly, quarterly, whatever, and then you'll recognize the revenue. That's the difference between point. But for you to recognize over time, 3 conditions are there. One of the 3 conditions, if satisfied also, it is okay. You can recognize over. Those conditions we will just understand what they are. The first condition is whether the entity performance, which means the company which is doing that work, is creating an asset which the customer is controlling. That is the first condition. They are saying if you do something, you should get an asset and customer should control. For instance, if on my land, if someone is coming and doing construction on my land, I can control that asset. This is doing it on my place, right? And then it will enhance the customer's value also. For example, basement is done, work is still done, right? First floor work is still done. It is enhancing the customer's value also. Second example, the entity performance does not create an asset with alternative use, and the entity has a right to payment for performance completed building. Example, legal opinions. The simple example we'll take. There is a complex legal matter which is very specific to your case. You went for a legal opinion. So the lawyer started writing the legal opinion. He is midway. Then you came and said, no, I don't want the opinion. I don't want. Then the lawyer will come and tell you, so whatever work I did, I cannot use this work anywhere. These are your facts. I lost my time. I cannot use this work for anything else. So I need to get money. No choice. And you signed a contract that you will pay me even if you don't take delivery from me. That is second. Meaning, there are also series of activities are there. Legal job is they have to do a lot of research, right? So basically, it's not a product like an apple which you can simply give. You have to do a lot of things, understand, assess, analysis, and all. So that entity's performance, the legal law firm performance, does not create any alternative use as an asset to any other person. That is only useful for that context, for that particular company in that situation, in that time frame. After a point in time, for the same company, after a time passes, also it's not useful. It's very, very fundamental and specific to that situation. So that's why in that situation, if you are able to get the payment till that time frame and till that period, yes, you can apply overtime condition. That is what we are trying to say. Last case. In this case, if it falls also it's overtime. This is customer is receiving and consuming benefits as and when the entity performs. Simple example again. Cleaning service. Say for example, this is the room. Okay. 30% of the room is cleaned. 70% is not clean. 30% is clean, no? Even if someone has to start the work, they will start with the 31st percentage and clean the room, right? Which means there is a simultaneous receiving and consuming benefit that is happening. In that case also, you can take overtime. So all the three, one condition should be satisfied. That's it. Just one practical example I'll give you. Again, if anyone of you are in real estate, right? If you have a residential property where the property guy develops all the flats, okay? You book a flat today, you get the delivery after 2 years, right? So the question there is, uh, by the end of second year, all activities will get completed. Okay, you made a booking advance. You are also making payments frequently for the asset. Say 2 crore is the flat cost. You are making periodic payments. Now my question to you is, now you have learned about a lot of concepts in 115, right? You tell me whatever we learned so far. Do you think the the construction company can actually take benefit of doing recognition over time in this fact pattern? Why?
It's not completed.
But uh, that building, as and when the construction is getting closer, it's enhancing the asset value, right? For example, when it started, there is foundation. Then they have done first floor, then they have done second floor. Each house also they would have done, say, base construction, they would have done flooring. But it's the progress is picking up, right?
Transfer of problem.
Actually, the issue is RERA. But yeah, you're bang on. So what government said is, till the time you complete your entire construction, till the time risk is yours. So if I am that is because of law that situation is created. Okay. But that's why that's a different case when the construction happens on my own land. If construction happens on my own land, then this will fit in that condition. But the difference between that case and a residential project case is, in a residential project case, the property owner has exclusivity over the land and the properties he's developing. He is only coming to you with an offer with one selling one flat. The issue is a lot of builders are backing out, and money of bankers is going for a toss. Also for consumer is going for a toss. Then RERA Act has come into picture and they said, boss, all this is okay. You can only, as a builder, your responsibility is up to construction till the time you cannot transfer the control to customer. That is the fundamental condition of all the residential project developers, which is why they will not go in overtime. They can only do point in time, which means they cannot recognize revenue till the flat is delivered. Compared to other example we discussed, right? So all our cleaning service, hotel management service, everything will go by overtime, monthly billing, right? Point in time means we discussed. Whenever there is a good supply, it's point in time. Simple. So this is overtime and point in time concept. So we completed all the concepts. Whatever we discussed, whatever we targeted 15 minutes before we completed. Okay, any questions?
If insurance company is a term insurance.
See, insurance companies standard itself is different.
Okay.
So the scope of the standard, if you look at the scope of the standard, okay, insurance companies, uh, leasing companies, okay, financial instruments, non-monetary exchange of goods between same line of business. For example, sometimes what happens is this happens in the oil and gas sector. So, for example, if I have a gradient of oil in one location, but I have no business there, but the competitor has it. So what they do is they just exchange oil among each other. No cash will get exchanged. Just between the location, they'll exchange oil. And this customer will be able to sell the output to the place where he has business. Same thing happens in car dealer also. For example, in Jaipur, people like, say, red color cars. But one dealer doesn't have red color car. The other dealer has red color car. They just exchange the cars among themselves and they sell it. There, IFRS 15 will not apply. Similarly, for insurance contracts, there is a separate standard. IFRS will not apply. So they are interesting. It is very interesting and different revenue recognition model for insurance. Yeah. Any other question? Okay. Thanks. You've been very patient, audience. I hope the session is useful to you. Thanks a lot for the time.
So please be seated.
Thank you, sir, for your presentation. You can have the explanation. I will keep chairman to present the management for. And that is management and management के जाए. वो मुझे ना किस तरह. किस तरह से. हाँ ना వీళ్ళు అందరూ పేషెంట్ లిజనింగ్ కన్నా కూడా ఒక నలుగురు ఉన్నా నువ్వు కూడా చెప్పినందుకు మధ్యలో ఒకసారి అక్కడ ఉన్నా ఆయన వాళ్ళ అది మధ్యలో వెళ్తే వస్తుంది I actually belong to Vijayawada. It's so great to deliver a session. It doesn't matter how many are there.
Sounds good, sir.
No, this is the standard. Anything more than 5. Yeah. Good audience.
We get 21.
ఉన్నారు.
ఇప్పుడు ఇంకా
ఇప్పుడు ఎలా ఏంటంటే అందులో జిఎస్టీ సో మొన్న జిఎస్టీ మీద పెట్టినా కూడా అలాగే ఉంది. జిఎస్టీ మీద పెడితే ఎప్పుడు హాలిడే ఇస్తారు, పెట్టినా కూడా అలాగే ఉన్నారు. అయినా మేము ఈ మంత్ పెట్టేవాళ్ళం కాదు మాక్సిమం.
చాలా మంది సిపి
auditing standards 2 hours is mandatory, and also code of ethics is also 2 hours mandate.
ఓకే.
అండ్ అదొకటి తర్వాత ఫస్ట్ నుంచి కాకుండా డిసెంబర్ లాస్ట్ లో కొంతమంది ప్రయత్నం చేస్తుంటారు. సో వాళ్ళందరి కోసం మనం చేయాలి.
అది నాకు ఆడియన్స్ ఎంతమంది ఉన్నారు, నాకు ఆపర్చునిటీ వచ్చింది, ఐ యూటిలైజ్డ్ ఇట్. ఇలా ఎన్ని ఆపర్చునిటీస్ ఉన్నా డెఫినెట్గా హెల్ప్ ఇన్ ద ఫ్యూచర్ ఆల్సో ఫర్ ఇన్స్టిట్యూట్.
వెరీ గుడ్.
థ్యాంక్స్.